Welcome students. This is the first video on our consolidated financial statement series. In this video, we'll be looking at different types of relationships that business organizations have. Now, we as individuals, we have different relationships, don't we? Similar to that, business organizations have different sorts of relationships with other business organizations. So in this video, we'll be looking into all these relationships in detail, and you will get a better understanding on how these relationships work and how do you determine which type of relationship you have with another organization, right? Okay, I'll be using relationship based examples to help you understand this topic. Now please do not judge me on this. All these examples are developed only to improve your comprehension on the topic. Now, when you look at business relationships, you see three main types of business relationships. The first one is called investments held for sale. The second one is associates. And the third one is subsidiaries.
Investments held for sale. These are the investments the company hold in the intention of resale when the value appreciates over time.
Now, when you look at investments held for sale, this is like a land that you are kept with yourself so that you will sell it on a future date when the land value appreciates. Okay, you are not going to use it, but what you are going to do is you are going to sell the land, right? You are going to sell the land when the value appreciates. It's the same with an organization. The parent company or the investing company, right, which is your company, is investing on another company, buying a very minority amount of shares. They keep those shares so that the value of those shares will appreciate through the share market, and when the value is appreciated, they will sell those shares through the share market.
Associates. Associate is when you do not have control but you have enough ownership to influence the decision making.
Then you have the second type of relationship, which is associates. Now, associates is like the business's girlfriend, right? Now, when you have a girlfriend, guys, you can influence the person, right? You can influence the decision making of that person, but still you are not one, right? When you get married, only the two people will become one. So, as an associate, the business organization or the parent company is investing a minority share holding in that organization. But this amount of shareholding is sufficient to influence the decision making process of the associate, right? For an example, let's say there is a company, there are shareholdings of 60%, which is coming from the major shareholder, and then your company has a shareholdings of 40%. Now, you clearly do not have control. It is the other person who has control because he has the majority of the ordinary share capital, whereas you have only 40%. But with that 40%, you can influence the decisions that the majority shareholder takes, right? Because you are a prominent shareholder, right? So this is what we call as an associate. Now, the organization will only benefit from the profit that the associate gets. The company will get a share of it, right? All the assets, liabilities, incomes, expenses will not belong to your company or the parent company who invested 40% in the organization, right? Now, for an example, if you look at your girlfriend's assets, right, your girlfriend's capital does not belong to you, right? It's hers.
Subsidiary. Subsidiary is when you have control over the other entity.
Now, subsidiaries is like the wife of a business, right? Now, Once you get married, guys, you become one, right? You get married and you become one. Now, your husband's assets, your wife's assets, your husband's liabilities, your wife's liabilities, all will become of one family, right? So, guys, the same thing will happen with organizations. Now, in this situation, you get control over the other company, right? When the parent company gets control over the target company, right? The company that they invest in, that is where the parent company enters into a marriage with the subsidiary. Now, for an example, if you look at a subsidiary's share structure, 60% will belong to the parent, whereas 40% will belong to another party. Now, owning 60%, you have control over the company. If you look at our definition on assets, an asset is a resource that is controlled or owned by an entity that would give future economic benefits. Now, all the assets of the subsidiary is controlled and owned by the parent, right? And also the liabilities, clear? So guys, this is what you call as a subsidiary. Now let's see how does one company get control over another company. We have looked at the first one, which is to get the majority of the ordinary share capital, right? The second one is to have the majority representation in the board of directors. Now you might have heard about private investors. Now private investors are investors who invest in the organization. They let the organization grow for time being, and then they will sell the organization by listing it in the stock market. But when you look at a private investor, the private investor appoints their own directors into the organization. Now their own directors will run the organization because they have a majority representation in the board. For an example, if you have to take a vote on a decision of the business and you have 5 directors from your hand and there are 2 directors from the other side of the organization, because all those 5 people are going to vote for you and you will have the majority power. Whatever you says goes, right? The third one is through a contract or an agreement. This is like marriage. When you get married, you have to sign for the marriage certificate. You get into an agreement between the 2 parties to live together, right? To stay together in sickness and happiness. So guys, when you look at a organization, when they get a subsidiary, they have these 3 different ways of getting control. And once you get control, once you have subsidiary, you create a family. Now when you have a family, you need to have family accounts, right? So this is where you get group accounts. Now group accounts, you call them consolidated financial statements, right? So in consolidation, what we are doing is we are combining the parents' financial statements with the subsidiaries' financial statements. We marry those financial statements together and then we have a family financial statement. Okay? Alright guys, so please subscribe to the channel. In the next video, we'll be looking at assets and liabilities of a group of companies. Assets and liabilities between the parent and the subsidiary. Okay, so see you in the next video.